to the point where now those inventories are kind of sitting right in the middle of the 5-year range.
Yeah.
And if you look at last week's exports, by the way, net exports of petroleum were like 4.1 million barrels per day. This is strong international demand on net coming from the U.S. that says the world has a voracious appetite for U.S. oil. That's the second highest weekly exports, net exports, by the way, ever for the U.S. last week. So this is really remarkable, and it shows that even with a kind of mediocre economy, this is pretty voracious demand, and it's continuing.
Welcome to an episode of Strategic Conversations. We host insightful discussions with top business leaders and top business minds. Today, we are hosting Dr. Dean Foreman, the Chief Economist for the Texas Oil and Gas Association. Dr. Foreman will be a speaker at the Houston Strategy Forum's upcoming 7th annual Upstream Summit. He has spoken at the forum several times, and he is a delight to listen. There is so much wisdom and knowledge. We're truly excited to host him. I'm Ravi Kathuria, the president of the Houston Strategy Forum and author of the management and leadership book, How Cohesive is Your Company, and author of Happy Soul, Hungry Mind. Strategic Conversations are hosted by the Houston Strategy Forum. If you value these conversations, please hit like and subscribe to the Houston Strategy Forum's YouTube channel. Today's episode is sponsored by Cohegic, a management consulting and executive coaching firm. Thank you for joining us, and we are looking forward to a great discussion with Dr. Foreman. Dean, thank you so much for being here. I appreciate you coming to the forum and enlightening us on all of that is happening. I mean, keeping up with the oil and gas markets is a full-time job. It's your job. I'm glad that you do that for us, sir, and continue to give us insight. So, Dean, I have been confused, and I shared this with Mr. Clay Bretches, who we will be hosting along with you at the symposium on April 3rd, is that the oil and gas supply dynamics, the narratives, if you remove the narratives, actually, let's talk about narratives. IEA was projecting that by 2030, we will see peak demand in oil. And then a whole series of CEOs, just last week at CERAWeek, have gone in and countered that. They've said we are not going to see peak demand anytime soon, right? And so as I watch the oil and gas markets, I always see this bull and bear narrative, right? And everybody has a narrative more convincing than the other. How do we make sense? What is the long-term demand dynamic for oil? Also, would love to find out, what does oil demand look like this summer and maybe even in 2025? Because where are we shaping up, right? How does this look? What is the physical market saying? I know the financial market spins it and manipulates. What does the physical market tell us?
Well, first, thanks so much for having me again. Your conversations are always really insightful. I think the audience that you bring together really creates some insight and reaches things where the pieces add to more than the whole along the way.
Yes, thank you. Yes, thank you, sir. Yeah, we love at the forum, our goal is to get 80% of the audience to contribute to the discussion. And when that happens, it creates magic. It really does. And especially when we have inspiring leaders like you on stage who help get the discussion going. We appreciate that.
So let me try to be as direct as I can on I think we should take supply as a separate question later, but let's talk about demand since the pandemic. And you've known me for several years. My consistent view, looking at the data, and I read no consultant reports on this stuff, I really look to the data, has been measurement that has shown that as we emerged from the pandemic, the behavior didn't fundamentally change. And in fact, we saw some fuel switching and some increase in petroleum, for example, going into materials.
Yes.
Chemicals, refining, naphtha, gas oil, propane, propylene, all these other oils that really took off as a result of people needing more packaging, more sterile and medical devices and such.
Yes.
And that's continued even as we're post-pandemic. We have this overhang of a lot more petrochemicals. It's still there.
Yes.
We have transportation across all modes that's continued to increase. And when we look at the relationship for global oil versus the global economy, we're back to another 0.5 income elasticity on this, meaning that if the economy grows 1%, you can expect roughly 500,000 barrels per day more oil needed next year compared to the current one. And that's where we are, where the world's economy with the upgrades, and let's cut through all of the expectations which have undershot the actual growth last year and again coming into this year. The latest IMF, International Monetary Fund upgrades have the economy at its long-run growth rate on a market exchange rate basis of around 2.7% per year. And roughly speaking, divide by 2 again, that gets you to about 1.2, 1.3 million barrels per day of oil growth this year, which happens to be the IEA's forecast for this year. The EIA, the Domestic Energy Information Administration, was slightly lower. OPEC and CAPSARC were slightly higher, but roughly speaking, the economy is growing, not just growing, but hitting record amounts each year.
Yes.
Oil demand already hit a record last year, and it's, again, any increase, even the least of them, means a record this year, a record next year.
Yes.
And by the way, natural gas, which has grown much more slowly with the economy since Russia's war in Ukraine and the shock to the system and what it did with European demand, but on a global basis, it too is still growing at a record amount of demand by IEA estimates this year and again next year. So here we are, despite energy transition issues, policy that's been designed to stem fossil fuel demand. And the world absolutely needs it for human and economic development. There is it's inextricable. And I think it's been plain in the measurement for a long time. Now, that's not to say that in 10, 20 years, things can't change. Things will and are evolving. But we need to have rational discussions about the speed with which this is likely to happen when it's government policy that's really trying to foist it onto consumers. And I think in the setup to some of what you've got for the discussion that's coming in April, consumer preferences matter here. And when you're looking at the technology and the cost effectiveness in an inflationary environment where we have debt overhangs at every level, nationally, corporately, household level, this really affects policy and expectations. The growth has hung together. It's been more resilient than people expected, but the energy demand to go with it has also been resilient.
So tell me this, you said we hit a record in demand last year. The year before where we had a record was back in 2019 before the pandemic.
Right.
And so tell us in 2023, what was the consumption of oil?
By EIA estimates, it was just over 101 million barrels per day. And it just by a sliver exceeded the 2019 level on a global basis.
And then this year, based on the 1 plus that you just talked about, so we'll get to 102 plus, right? And then
almost 102.5, and then we're looking at 103.8, something like that by EIA estimates.
By EIA estimates. Now, last year we had so much focus on China. They said Chinese demand is weak. Chinese economy is crumbling. China is going to be wiped out of the face of the earth. China is right. And in spite of all of that, what you're sharing is that oil demand has reached global records, right? It's historical records. So go ahead, please.
Well, remember my words this time last year when we were discussing this exact issue. And my response was the playbook for China has historically been depreciate your currency, lean back in the playbook on export-led growth. Check, that's happened.
Yes.
And by the way, there's a lot of energy that goes into the manufactured goods that they're creating. And by the way, they're pumping a lot of liquidity into to prop up the real estate market. So they're still building.
Yes.
And coming into this year, the outlook that I had in December, and this has played out to script exactly, the International Monetary Fund, starting in the third quarter last year, had an estimate of just 4.2% growth for China this year. 4.2. And it came in like between 5 and 6
Five.
for last
Yes.
year.
Yes.
But they sandbagged it to such an extent
Yes.
that
Yes.
I looked at it, as did others, and said, this isn't realistic. That would be the single lowest non-pandemic growth for China since 1990.
Yes.
So look, in their January updates, January, February, they came back and they raised it to 4.6. That's still conservative.
Yes.
Because look at the demand for the exported goods from China, and you just see this isn't 6-7% growth like China's had in the past.
Right.
But it's also not plummeting. The demand for their underlying goods is very much there.
That's right. China is not in recession. They're still growing 5%. This is a sizable economy. Chinese economy is growing 5%. The US economy, the world's largest economy, is not in recession, even though for 2 years we have had pundits on CNBC crying wolf and saying there is a recession, there is a recession, look, there is a recession. The US economy is growing. The US economy is growing. Chinese economy is growing. Indian economy is growing, right? The biggest consumers of oil, these economies are growing. Europe, I guess, is not growing as fast, but Europe is not cratering like they had said it would. And you have a world economy that is growing. Hence, it's very easy to see while oil demand is hitting new records. We have come back from the pandemic and the economy is just fine. We went into the pandemic, we bounced back, and the economy is growing. Oil consumption is growing. All right.
Well, let me interject and highlight one wild card here. And it's not in the base projections. We don't see it in economic indicators playing out as recessionary, but it is why the Federal Reserve will have to cut this year. And those debt overhangs that I mentioned at the national, the federal, and the household level, households are carrying, by New York Federal Reserve Bank estimates, $17.5 trillion worth of debt, never higher. Delinquencies have picked up, but they're not at recessionary levels. Corporately, the IMF and the Bank for International Settlements have put some really thoughtful research out showing that $5.5 trillion worth of debt corporately must be refinanced starting this year, and it's 4 to 5 each of the next 2 years after this. But it has to be refinanced at rates that are 3 times higher than what they were at the end of 2021. And the impact of this, the BIS's working paper is really interesting on this because it shows that it's primarily small and medium-sized companies that are impacted, and that it doubles their obligation as a share of their profits for debt maintenance. So it really is either you cut rates or you are going to slow corporately within the year.
Yes, I appreciate that very much. You're absolutely right that the commercial real estate market, people who have to take short-term loans, right? These are not long-term loans that we can get for residential markets. The commercial markets are shorter terms, and these who financed back in 2019 at the historic lows are all up for renewal. These loans have to be renewed, and higher interest rates are going to cause a lot of heartburn in the economy. And so we all wish that the federal, they have been trying to get inflation under control and get to the 2%. But that seems to be a little tricky. It looked like end of last year, maybe we were getting there, but now as 3 months have gone in this year, looks like we're somewhere between 2 to 3%. So it's proving just a little stubborn to get back to 2%. But to your point, the Fed probably has to seriously consider lowering interest rates so that the economy does not flip into a recession and it cause problems. Not the kind, last year we had the banking crisis. Hopefully it did not grow into a full-blown crisis, but you do see issues around that. So let's talk about that for just a second. In your report and other places, people have said if the Federal Reserve begins to cut down interest rates, that is actually supportive for oil prices. How is that? Help us understand that, please.
Well, look, it's not a direct causation, but when you, we can talk about on the path up or the path down, but you cut the interest rates, your single biggest impact in determining the strength of any currency around the world is hot money chasing interest rates. If you raise your interest rates in the US slightly above those in Europe and Japan, companies have a stronger incentive to hold dollars and invest in term deposits in US dollars as a result of that.
Yes.
And as you cut rates, it's exactly the opposite. So you're narrowing the carry trade that exists versus other currencies.
Yes.
You're going to shed some US dollars. If that says that this is broadly supportive of broader growth, the US isn't just the prettiest horse in the glue factory, so to speak, anymore.
Yes.
And as some air comes out of it, as the dollar comes down, historically you've had this inverse correlation
with oil prices.
And it's a function both of, you can explain it in terms of oil getting, in that case, since oil is traded in dollars, as if the dollar takes some air out of that versus other currencies, now oil is relatively more affordable around the world. That increases demand and hence higher demand, higher prices. Separately, just in terms of how you hedge in a financial market, versus inflation, sometimes buying the commodity is the thing that you do to offset that. Commodity trading dynamics are another rationale by which this plays out. So for multiple reasons, correlation isn't causality, but that correlation, it hasn't just existed. It's been like in lockstep since 2006, every quarter, if you plot it out. And the relationship, it's not that it can't for short terms perturb away from that, it does, but it's been working its way back and you see it. And the dollar is still historically high, although some errors come out of it. And if the dollar isn't in a flight to safety mode, we need to see where that goes. The better the economy does, the more diversified away from the dollar it'll become.
Yeah, I thank you for explaining that, and I see that now. Is the dollar moves lower, it will help drive interest and demand for oil, which is always the case. The question is, as the Fed thinks about lowering interest rates, I suspect they expect that oil prices will go up, which in an election year is never, it's for political leaders to be comfortable with oil prices rising. At what point, the economy has grown, wages have grown, and on an inflation adjusted basis, oil prices have not really gone as high, right? If you had it. And so at what point do you think that voters or consumers begin to feel the pinch, where that translates into it begins to influence their voting decision, right? I mean, that's what campaigns are looking at. And I don't know if the Federal Reserve is looking at that, because the Federal Reserve is independent of political considerations, we would hope. But, right, at what point, where is that parity? At what point do consumers how high could oil prices go before consumers start feeling the pinch?
So a few thoughts on this. And as a trade association, we don't really predict the price or tell exactly where consumers hit pinch points. But, it's the cumulative effect of price inflation that's been a boiling frog syndrome for consumers. It's broad price inflation, right? So looking at how far the dollar goes, when your electricity has gone up substantially, your utilities have gone up substantially, your housing's gone up a lot in certain areas.
Oh, yes.
And on top of this, your gasoline's up right now.
Yes.
It's not as up as, think of immediately after Russia's war in Ukraine, you got up to $133 a barrel for a certain point. And we're sitting in that 80 to 90 range, right? So it's not horrible. It's not historically low. And I think we could look at this as glass half full or glass half empty, in the sense that, on one hand, for all the geopolitical concerns in the Middle East and other places, we only have $80 oil. But on the other hand, you can say, well, for all the economic uncertainties we still have $80 oil. So either way, it's kind of in a sweet spot right now that has been affordable for consumers so far. It's kept the economy on track. In other words, the economy is not showing signs of breakage because of this right now. And historically, when we've seen things spike to 130, or if you were price adjusting, either 2007, early 2008, or if you were inflation adjusting 2011 to 14, now you're talking about $150 oil. And we've shown that if you go there fast,
Yes.
that it really shocks consumers and it makes it unaffordable in a short period. But these kinds of price levels in 2011 to 14 were very consistent with sustained global expansion when it happens slowly. So if it gradually adjusts, it's not about the price level per se. It's about how everything kind of moves in a system that enables people to understand and predict and plan.
I love that point. As long as it doesn't shock people, as long as the emotional reaction is not there, then people are okay with that. And then because their wages have grown and everything else has inflated. I want to go back to we understood demand. We understood that the world economy is growing. The world economy is healthy, barring the real estate issues that you talked about, the debt that there is. Hopefully, the Federal Reserve takes care of that. So demand for oil has gone up, is at record highs. OPEC has cut back on supply. The US production has now gotten back to pre-pandemic levels. So it's flat if you compare to 2019, a little bit higher, right? But in the same ballpark, 13 plus minus. And then OPEC says it has cut back, has spare capacity. How is it possible that we are at a record high in demand and supply still being constrained? I don't understand. So in 2019, we were in sync. Now are we out of sync? And there are reports that global oil inventories are drawing down. Is that where this gap has been filled from? Where does it reconcile? If I'm at the highest record demand and my supply is being held back, how come I'm not generating a bigger deficit? Is supply demand in sync, or is there a gap? What is happening? Where is new supply coming from? How do I solve this equation?
So it's great that we're shifting from the demand side to the supply discussion. We should add one more point on demand, though, and that's divergence between the official sources on this. Yes. And some, as you noted, are a lot higher than others. And we've continued to show that the stronger demand estimates along with the economy have been what's proven to be accurate. But when people expect low demand, that can affect the pace of investment. And here we are, where because of the elephant find in Guyana in particular, but also investment in Brazil, some in Norway, some in Canada, we're seeing the fruits of some long lead projects, 3 to 5 years worth of investment finally coming to market. So there's been some non-OPEC supply growth over the last year, and that's continuing this year.
How much is the magnitude of that non-OPEC growth from Brazil, from Guyana, and from Canada? Is it over a million barrels a day, or is it less? Is it 500,000 barrels? Because Guyana, and Suriname, I guess it's 2025, 2026 when it starts producing. So are they ahead of schedule? Brazil has gone up, but I'm trying to figure, because Saudi Arabia and OPEC have constrained how much? 2 million barrels, is that right?
That's how much they've taken off market. Their spare is between 3 and 4 at this point.
The spare is 3 and 4, and so they have held back production of 1.5 to 2, right? And so
U.S. and Guyana and Brazil, Norway, Canada, those are really your sources of growth. That's what's made up the difference. And last year, the U.S. was your biggest source. There are expectations that some of that growth this year from the U.S. starts to slow, but it's also picking up in non-OPEC. So OPEC maintaining discipline has had a lot. OPEC Plus, including Russia, maintaining discipline has had a lot with stabilizing global markets. But because demand growth has continued, that's enabled this puzzle to fit together with the kind of substitution that you've mentioned.
I guess maybe I should ask a direct question. Are producers supplying 102 million barrels of oil to the market every day at this point?
if you look at the estimates of global stock withdrawals, they're probably supplying about 500,000 barrels per day, less than that. And we're through the first half of this year, by official projections, we're drawing on inventories to 500 to 800,000 barrels per day worth. I think the exact estimate of the first half of the year is closer to 800,000 barrels per day. So what's interesting about this, though, is that estimate keeps rolling forward. So in the EIA's short-term energy outlook, if you take it apart, they were showing coming into this year that the first quarter would be a deficit, but then starting in the second quarter, the market would be balanced. Starting in this month's outlook for March, they showed that, oh, no, it's through the first half of the year. And if the dynamics don't change, if the economy remains solid, you might expect that could roll into the third quarter or even the fourth quarter. So the inventories come down. The thing that I also look at is your both strategic and industry held inventories in the United States.
Yes.
And at the beginning of last quarter, the U.S. inventories were at the very bottom of the 5-year range. They had been drawn down substantially. Then we went through 6 consecutive weeks of inventory builds in the U.S. to the point where now those inventories are kind of sitting right in the middle of the 5-year range.
Yeah.
And if you look at last week's exports, by the way, net exports of petroleum were like 4.1 million barrels per day. This is strong international demand on net coming from the U.S. that says the world has a voracious appetite for U.S. oil. That's the second highest weekly exports, net exports, by the way, ever for the U.S. last week. So this is really remarkable, and it shows that even with a kind of mediocre economy, this is pretty voracious demand, and it's continuing.
Wow. Dean, I can't wait to host you on April 3rd. I mean, this is going to be one fiery discussion. I mean, there is so much to explore. I hope everyone who's listening to this is going to please come engage with Dr. Foreman in person. I mean, you can see if you don't get a sense for how much information he has and how much insight he has, then I don't know. Please come engage April 3rd at the Houston Strategy Forum. It's going to be an interesting discussion at our Upstream Summit. And the topic of our discussion is Upstream Dynamics. This is exactly what we're going to talk about. Dean, I am looking forward to hosting you, sir, in a couple of weeks.
Great.
Thank you so much. Appreciate it. Yes.
Thanks, Rob. I'm really looking forward to it. It'll be a great discussion on the panel.
Yes, sir. Thank you.